Right. Sorry for the 1-2 minute technical insertion. They had difficulty in accessing the PowerPoint shared in advance. Anyway, we can start where we stopped our discussion, the behavior of interest rates at our last discussion. And effectively, this section would give you much more insight into how interest rates been explained both theoretically and practically, with some theories that explains the behavior of interest rates. And I touched upon this in our last lecture, where I highlighted the fact that the levels of interest rate, when we say interest rates, I always said, unless otherwise somebody very specifically highlight that the interest rate that they are discussing, referring, are real interest rates, always and everywhere. By just mentioning interest rates, it means the nominal interest rates. Okay, so whenever somebody refers to 8%, 9%, 10%, 5%, it means to say it's nominal interest rates, right? So if somebody very precisely say real interest rates, then you can kind of infer differently, because we discussed the Fisher equation. What is the real interest rate? Real interest rate is the interest rate, right, adjusted for inflation. So in a sense, what you are basically doing is nominal interest rate that we are discussing is nothing but the real interest rate plus expected inflation, right? So if it is real interest rates, the equation would say you take the expected inflation to the other side, nominal interest rates minus expected inflation, you get the real interest rates. But generally, when you say interest rate, it is nominal interest rate. But interestingly, when you compare these nominal interest rates, even within a year, if not over a period of time, the levels of interest rates are different. At times, it is double-digit interest rates, and you find all of a sudden it is almost 5%. Or if it is close to zero, people say low level of interest rates. Okay, that is true not only in developing countries, including Sri Lanka. Now, Sri Lanka's 1-year interest rate, treasurable interest rate, is about 5%. It came down to 4.5 level also. Whereas at different periods of time, this 1-year interest rates have touched over 20% in Sri Lanka, right? Late 80s, right? And also towards 2008 period, like it's almost come closer to 20%, right? So what you are basically seeing is, even now in advanced economies like US and OECD countries, you probably see the interest rates are very low. But they also had episodes where the interest rates were closer to double-digit numbers, if not double-digit numbers, not closer to double-digit numbers, but it's more than 10% in some cases. And at the same time, in some countries, the experience say interest rates also have gone negative. Nominal interest rates have gone negative. But you can fix this nominal interest rates into the Fisher equation, where you can put this into the negative perspective and fill the other numbers requires in the equation. Still, you can say negative interest rate carries a positive real interest rate. That's possible, right? If the expected inflation is the bigger negative than the nominal interest rates negative, you find a real interest rate is positive. So you can figure it out, this type of details, in a general interest rates that we discuss. But interestingly, in this section, right, we examine how the overall level of nominal interest rates behaves. 5 1 and 2 Gita teman video mama on head climate forward කරන්න මේක ඔව් දැන් ඒගොල්ලන්ට අප්ලෝඩ් කරන්න පුළුවන් රිලැක්ස් කරන්න මේක දැන් තියෙනවා මේක තමයි කරන්නේ ඔය ඊමේල් එකක් තෝරනද සර්වර් එක දැන් ඒක තමයි මම මුලින් අප්ලෝඩ් කරනවා that's it I'll be a second. Make a make a දාලා තියෙනවද chapter 5 clean කියලා කරගෙන මේකට හොට් කරන්න බෑ හොට් කරනකොට මම දන්නවා බේරන්ස් හරිද AAVINDRA@IBSL.lk දැන් හම්බෙලා තියෙනවා share with the middle if you have not got the email please bear with me for 1 or 2 minutes they will upload the presentation again so you will be able to have the slides available with you but anyway I mean I'll take you through these first few slides with little more detail until you have the access to the presentation. But interestingly, as I was highlighting the levels of interest rates, it's like a height. I mean, once you see the people, how the height changes from little kids to adult throughout a certain period of time, it's like that. So you have certain level and then you go up to a certain level. So it is like interest rates levels. So you can see these interest rates differs from time to time based on many other driving factors. Why the interest rates changes? There are many literature you find that there are thousands of factors you can line up, but there are major few factors that we would be looking at. But generally, as you already know from Fisher equation, where you are trying to kind of look at the concept of real interest rate. So the expected inflation remain one of the key drivers of these levels that you experience across different periods of time. So in this section, in this lecture, we try to examine, right, overall level of nominal interest rates. Okay, when you say simply interest rate, it's nominal interest rates, as I was repeatedly highlighting, unless otherwise somebody very specifically say it is real interest rates, right? So this concept of nominal interest rate is determined, and which factors influence their behavior. That's the focus of this particular section. And we learned in our previous sections that interest rates are negatively related to the price. That is already like a mantra that we have already studied, where higher the interest rates, lower the price of bonds, right? So for that matter, lower the interest rate, right, higher the price of the bonds. It has a negative relationship. When the interest rate increases, price decreases. When interest rate decreases, price increases. So this is what you have to remember. So if a price is increasing from 92 to 98, for sure interest rates would have 92 to 98. Remember, price has increased. So interest rates would have definitely decreased from a higher interest rate level to a lower interest rates level. So this is a very interesting behavior that you have already aware. So if we can explain why bond prices change, right, we can also explain why interest rates fluctuate. So we try to figure it out why the prices changes. So from that itself, right, we can figure it out, the fluctuation of interest rates. So that's the focus of this section. We examine how this interest rates is determined and what factors influence their behavior. Okay, to do this, we take a very simple economic principle, supply and demand. You are very familiar with this. So we look at the supply and demand analysis in the bond markets and also in the money market. Bond market and money market is often work very simultaneously closely, but the difference in money market is often not long tenor, short tenor, right? Short tenor financial assets trade in money markets, often less than 1 year. Okay, so that's how we used to employ this supply and demand. You are familiar with this in your general economics. For goods, mangoes, whatever that you are familiar with, you have learned about the supply curve, demand curve. So we will use same approach in looking at how the prices and interest rates being determined in the financial market, right? So to derive this, derive the demand curve for this particular analysis, right? For assets like bonds or money in the market, the first step in our analysis, we must first understand what determine the demand of these assets. So the determinants of asset demand, in other words. So what determine the demand for these assets? So we will focus on that aspect also. Okay, so we also do this by examining economic theory known as theory of asset demand, okay, which outlines the criteria that is important when deciding how much of an asset to be purchased by a investor, or for that matter, a rational human being, right? So this theory of asset demand outlines how much of an asset one buys based on the behavior and the details that we would be studying in this theory. Very straightforward. You will see that when we start discussing. Okay, so we can also through this theory, we can also go on to derive the demand curve. I mean, when you are looking at a supply and demand analysis, you have to have a demand curve being built. right? So you know at different prices how much quantity being purchased. That's your general understanding of demand curve structure in your general macroeconomics or general economics. So we will be looking at same approach in determining demand for bonds or money in the financial market. Okay, so after deriving the demand side, we also look at supply side of these assets. Okay, so the supply side, sometimes it's not necessarily usual supply curve that you must be seeing, but generally yes, you will see the same usual supply curve that you are familiar with. But at times you might see horizontal, in fact vertical, not horizontal. It's a vertical kind of supply curve, because supply is determined by government's behavior and things like that, or central bank's behavior in the case of money market, where the money supply is determined by the central bank, how much quantity to be supplied. So it is irrespective of interest rates, right? It's a vertical line, like supply curve would look like that. So we will get into that, and through which you can look at your demand curve, and you have the supply curve, and you know the concept of equilibrium. So we will look at that in this section, and through which quantity supplied, quantity demanded can be looked at, and where it is equal, that is the equilibrium point from your general economic understanding. So through this we can understand and explain how equilibrium interest rates been determined, and analysis for this particular program. Okay, and the other element is you probably see interest rates of different financial assets, financial securities tend to move together. Okay, and it's like if one financial asset's interest rate structure, you probably see it's increasing. And other financial assets also, there's a possibility the same pattern being followed. This because these financial assets are often interlinked to each other, if not mostly are alternatives one for the other. So if you are not happy with one financial asset, you move to the other financial assets. So they tend to have some similar behavior, but at times this behavior would not be one-to-one. If one asset's increased by 3%, you don't expect other asset to increase in the same way. It depends on other elements, but sometimes these financial assets would say one asset's increasing, the other assets would decrease. That's also possible because of the elements like risk involved in those financial assets. We will be looking at that element also, right? So we will see in this section, we will proceed as if there were only one type of security and a single interest rates prevail in an economy, to simplify our analysis. You have thousands of financial assets in an economy, but we will look at in this section, it's like only one financial assets is available for you, like bonds available. Bonds is the financial assets in front of you. Supply and demand side is there. So we will try to establish that and analyze on that basis, and then see how the different type of securities, once you establish the equilibrium and understand the concept, we will move into that element in identifying this. I hope now you have access to the PowerPoint or the handouts for the discussion, and then we can move on with little more details. If not, you can have it in a little while, and you can have more clarity in terms of what you are now discussing, what you are now following in terms of the discussion. If you have any question, please feel free to raise it. If not, you can put down in the chat mode so we can follow that too. Okay, so as I said, we will look at what determines the asset, financial asset demand. Okay, so we are in the direction to establish the demand curve. So we are looking at the asset demand, what determines the asset demand. So one of the very interesting aspects here is the so-called concept of wealth. Okay, So wealth is much broader than your income, right? So income from employment, income from investment, right? You may have paychecks that you are receiving because that you are working and you provide your a human resource to an organization and you get paid for it. That's an income for you, right? But wealth is much more broader. Maybe your parents might have left some assets for you. Maybe you have found some windfall gains, right? When you are walking in the garden, you all of a suddenly find gold pieces in your garden. So it's something, I mean, you didn't expect. But that is part of your wealth now, right? Then you see all of a sudden you have other elements of returns, right? So even collections of art, right? Valuable antiques. There are many other aspects. Properties, all is part of this wealth, not only the income that we must be receiving through our employment or any other form of known source. It's a collection of many type of returns that's accumulated and available for you, right? So total resources owned by an individual, okay, and assets like your properties you have. When you see much more properties available for you, you are wealthy. So your ability to demand more assets is very much favorable when your wealth is you are a wealthy. So what you are basically seeing here is wealth appears to be positively related to asset demand. We will get into that, right? So then you see expected return. Okay, so you expect returns from your investments. You know, as I was mentioning, there are many assets, financial assets in the financial market, right? So you compare, right, the return expected from one asset or the next period in relative to other financial assets available. So you are looking at a bond, right? So compared to bond, what you look at in terms of other financial assets are compared here in terms of its expected return. You may look at a saving. Saving is giving you 4%, whereas a bond is giving you 7%. So the expected return of a bond is high, right? So this expected return is also another important determinant of asset demand. So you have wealth, now you have expected return also for consideration. Okay, so you always see expected return of your interested financial assets in comparison to other alternatives that you have in the market. Then the risk. Okay, so the risk is also very much important in the sense that the risk associates so-called uncertainty. Uncertainty in terms of the return on one asset relative to other assets that you are interested in. Whether you will receive your investments, you will be able to recover your investments. Your deposits in a finance company versus your deposits in a commercial bank. Then you look at the same within that category itself, levels of uncertainty associated in terms of that particular organization itself. So you look at this and return of a government bond against a corporate bond, or for that matter against different asset classes, bonds versus deposits, government bond versus you look at treasury bills versus other investment opportunities available in the market. So you see this, right? So you see this uncertainty element in terms of the asset that you are interested in, how uncertain the returns of this asset that you are looking at in related to other assets available in the market. Okay, so that also a very important determinant. So you now know wealth, expected return, and then you see the risk, right? So you see these elements, and then you see another very important factor, that is liquidity. So the liquidity is also a very important concept that refers to how easily and how quickly you can convert an assets into cash form. You see, you can very easily trade treasury bills, treasury bonds. These are very much liquid and the market is always available. Of course, as I was discussing in our last lecture, before the maturity, if you wanted to trade, you had to take the interest rate risk. You might have a capital gain or a capital loss. That's a different equation altogether. But you can convert it to cash, right? Or you can collateralize it and you can go for other financial assets. There are lots of ways you can use these treasury bills, treasury bonds for that purpose. And look at the real estate. You have a land, even you have a motor vehicle. Compared to these financial assets, it's difficult to convert into cash form, right? Takes time. You have to go through processes, right? So legal documentation processes. Everywhere, even in financial assets, legal processes are there, but relatively established, and it's a part of the financial assets itself, right? So the liquidity is another very important concept, where the ease and speed in which you can convert an assets into cash form in relative to other assets. So you know now the determinants of these assets are either wealth, expected return, risk, and liquidity. You can again line up few other elements, but these are the major elements of determinants. Okay, major determinants of asset demand. You can bring in other elements again and put into one of these categories, right? So you see these elements in our equation. Any questions? Right. So let's move on. Let's move on and discuss these elements. Okay. So you see determinants of asset demand, right? Wealth, right? Wealth we looked at. Then we looked at expected return. Then we looked at the element of risk and also liquidity. And then we are looking at, okay, the theory of portfolio choice, where you look at financial assets and try to select it, your choice of financial assets. Okay, so the theory of portfolio choice look at this in the form of so-called ceteris paribus, other things constant concept in economics. You keep everything else constant now and only look at so-called wealth. There may be other reasons that would change the general behavior, but by holding them constant, you only look at wealth, and you will see quantity demanded of an asset is positively related to wealth. The higher the wealth, more quantity being demanded. Lower the wealth, less quantity being demanded. So it is positively related. Okay. So then you look at expected return. Then you look at the expected return of a financial assets that you are interested in. The increasing, okay, right, expected return would have higher quantity demanded of the assets that you are interested in in comparison to other assets. So that refers to positive relationship of quantity demanded of the assets that you are interested in line with its expected return. So higher the expected return of the assets that you are interested in, higher quantity being demanded. It's a positive relationship. So wealth is a positive relationship. Expected return is a positive relationship. Okay. Then you look at the risk, the uncertainty in which your return being realized. You want the principal, you want the interest of your investments. But this is the risk in terms of the realizing of this expectation is an element market is always factoring. And then you look at, in comparison to the asset that you are interested in, how the risk is. So risk is negatively related to quantity demanded of that assets. Okay, so you look at this here. If the higher risk that you feel and you see, you demand less of that asset, or you don't not at all demand. So in the market, if an asset is highly risky, the probability that market would not necessarily demand much. There may be few risk lovers, so that's a different game. But what you are simply seeing is the risk is negatively related to the quantity demanded of an asset. Okay, so then the liquidity, speed and ease in which you convert your assets into cash form. That's the liquidity. You see here, compared to other assets, if the assets that you are interested in has a higher liquidity, that has a positive relationship to quantity demanded. Higher the liquidity, more quantity being demanded. So from the theory of portfolio choice, holding other aspects constant, other factors constant, ceteris paribus condition in economics, you see the wealth, expected return, and liquidity positively related to quantity demanded of an asset, whereas risk is negatively related to quantity demanded of an asset. Please remember this. This is a very important understanding rationality, because when you see somebody is asking what happened to the asset demand when one of these elements changes, you should be able to foresee which direction the demand curve will behave. Okay, if the wealth is increasing, that you know now, the quantity demanded is increasing. So the wealth itself drives the demand curve to expand. Expected return is also of that asset. Risk is opposite. If the risk is increasing, what happened to the demand of that asset? It reduces. So the demand curve would shrink, not expand. So you can see it moves to left, it moves to right. So that's what we are looking at in terms of the demand curve analysis in this exercise. Okay. So you can put this, okay, the response of the quantity of an asset demanded to changes in wealth, expected return, risk, and liquidity into a more straightforward explanation here. So the change in variable wealth is increasing. You see, change in quantity demanded also increasing. Expected return related to other assets, the variable is increasing. You also figure it out. Quantity demanded also increasing. Then you see risk related to other assets. Risk is increasing. but then you know it's negatively related to quantity demanded. So the quantity demanded is decreasing. Okay, so then you see the liquidity concept. Higher the liquidity, more quantity being demanded. So all variables that we are seeing here are in the direction of increasing, and the quantity demanded is generally increasing except in the case of risk. So the wealth, expected return, and liquidity is positively related, whereas risk is negatively related. Okay. So this is very interesting because we looked at this to drive the demand side of the financial asset. So the demand curve. So we will get into these elements and see where the demand curve is heading. Then you see again the supply side. Okay. So you probably know at lower prices, you know price and interest rate relationship. At lower prices, which means higher interest rates, other things constant, set to spread plus. At lower prices, higher interest rates, the quantity demanded of bonds is higher. Price and quantity demanded, you see, has a lower inverse relationship. Lower prices means higher interest rates when you look at interest rates and prices compared. But at lower prices, you see more quantity being demanded. Nothing different to your general behavior in the market. You see mangoes are cheaper. You demand more. Coconuts are cheaper. You demand more coconuts. Right? The shoes, handbags, right? Then you see the dresses, apparel. So when the prices are low, you find higher quantity being demanded. So you find a inverse relationship, price and the quantity demanded. So price and the interest rate, you already know, has a inverse, if not negative relationship. Lower the prices means higher the interest rates. Higher the prices mean lower the interest rate. Lower the prices drives to higher quantity demanded of bonds, financial assets. Demanders like to get higher return. So when the prices are lower, interest rates are high, so they demand more. That's the demand side of the financial market. Then the supply side. At lower prices mean higher interest rates. But if you are a borrower, right? So you probably not happy to supply bonds at lower prices. You see that lower prices means higher interest rates. So why should I sell more bonds when the collection or the price I am receiving is lower? I had to pay a lot of interest cost. My interest cost is very big at lower prices. So what you do there is you quantity supply to the market, you also reduce. So the lower prices, you find lower quantity of bonds being supplied, and there it's a positive relationship. Low prices, low quantity supplied. High prices, high quantity supplied. So it's a positive relationship. The demand side at lower prices, right? More quantity is demanded. At high prices, less quantity being demanded. So it's a negative relationship, inverse relationship. Okay, so you see the demand side and the supply side. Please don't confuse. There is no difference to the price and quantity demanded, whether it is a bond or whether it is a mango or a coconut or a apparel, whatever that you are familiar with. So the behavior in terms of price and quantity demanded in the demand side is negative. In the behavior of price and quantity demanded in the supply side is positive. Even condominiums, houses, right? So condominiums are low price. You might not find much supply from the suppliers. But condominiums are low price. You will find more demand from demanders. So there is no difference in terms of your general understanding of economics and applying that into the demand and supply curves into the financial market, where supply and demand of bonds, we have put all financial assets into bonds perspective and analyzing it. So you see this the demand and supply curve in this chart, where the bond demand curve is BD, where the bond supply curve is BS. And you see here x-axis, where the quantity demanded of bonds in billions of dollars, right? So this is US market example. And you see again a price of bonds in your dollars, right? So you can see here, when the price of bonds is equal to 1,000, that is the par value or the face value, you buy the bond at 1,000 and you maturity also, you get the maturity at 1,000. Here there is no coupon or anything explained. Okay, even if there is a coupon, this bond is trading at par. So you probably see here other things constant. We look at only price and quantity demanded, right? So price is almost high as 1,000. There is no demanders in the demand side. But you see price is reducing now from 1,000, where the interest rate is 0. Price is reducing to 950. Okay, so from 1,000 to 900 means in price is reducing. So interest rate is increasing. So what you are basically seeing here is, when price reduces from 1,000 to 950, interest rate has increased from 0 to 5.3. And you find the demanders demand at point A, in quantity terms, it's about 100 billion. And similarly, you can figure it out. The price is gradually reducing towards lower prices. And you can figure it out at price 800. The interest rate is now 25. You can figure it out demanders at point D, which amounts to quantity of bonds of 400 billion. And at price 750, interest rate is 33. You figure it out. In this example, the quantity demanded of $500 billion. So what you are basically seeing is, at high prices, lower demand, and at low prices, higher demand. Inverse relationship. So you now collect and connect these points of price and quantity demanded of bond demanders, and you can draw the so-called bond demand curve. This is the demand side. Then you look at the supply side. Any question before that? Right. So now you are seeing the demand side, and it's clear. At high prices, lower quantity demanded. At low prices, higher quantity demanded. The relationship is inverse with price and quantity demanded. And you know already the relationship between price and interest rates. Okay, so higher the interest rate means lower prices, so more demand at higher interest rates. So you can see that the curve is downward sloping. And then you are seeing the supply side. As you already know, at lower prices, suppliers are reluctant because their cost of borrowing or supplying, that means they wanted to raise funds. So it's cost of financing or cost of borrowing. At lower prices, cost of borrowing is high. So they prefer to supply less. So at price 750, at point F, you find suppliers are supplying only 100 billion. And as price increases from 750 to 800, more suppliers coming into the market, right? So the interest rate, as prices have increased, interest rates have decreased from 33 to 25. So the quantity supply also increased as price increased to 200 billion at point G now. So similarly, you see as the price increases, the suppliers supply more bonds to the market. And at price 950, you can figure it out, more supply coming to the market. And in the chart here, the example exhibits it's $500 billion of supplies, and the point is I. So you connect these points and draw the supply curve. So it is BS, right? It is upward sloping supply curve, right? So downward sloping demand curve, upward sloping supply curve. As the price increases, more bonds being supplied, it is positively related. As price increase, less bond being demanded, it is negatively related. And these two, bond supply curve and bond demand curve, meets each other at the equilibrium point, that is point C, where these two curves interact each other. That is the point of equilibrium, where the market cleared supply and market cleared demand amounts to, in quantity terms, 300 billion, and in price and interest rate term, price is 850, and the interest rate is 17.6%. So what you are basically seeing is this market has the suppliers and demanders, but at the same time, the market equilibrium on the basis of their behavior. And at points above C, where the prices are high, more suppliers, HI, these are suppliers. More supplies available, but less demand because people want higher interest rate. Demanders not happy to buy the available supply because their interest expectation, and suppliers interest expectations are not matching. So they have to give in. So the suppliers are ready now, okay, we will give little more in interest. So they, from I, they come down to H. And now some demanders, they are happy to accept that higher interest rate. That means 950 to 900, the prices are reducing. So you find more demanders coming in. Some suppliers not happy, they just move out. Only 900, you see point B in the demand side, point H in the supply side. So still, the demanders are only demanding 200, although suppliers supply 400 there. There is a disequilibrium. That means you find excess supply prevails. At points above the equilibrium point, you find in the bond market excess supply, okay, and points below you find excess demand, where the price is low, more demanders are happy to buy bonds, whereas suppliers are not happy to supply at those prices. So there's a high demand at points below equilibrium, that is point C here, and that is excess demand. So to take out the market excesses at excess supply points, suppliers give up their price advantage. That means they are happy to lower the prices. At points where demand is excess, the demanders are now ready to give away their price advantage, where they are happy to accept some increase in prices and give away their interest return. So this is what pushing market inequilibrium into equilibrium towards point C. So ultimately in this exercise, what you are simply seeing here, the equilibrium price is 850, equilibrium quantity is 300. So this is the simple, straightforward supply and demand curves for bonds. And as I was explaining from the very first lecture, right, the conceptually, the financial market and economics of monetary policy, right, has its elements, but the working in terms of market dynamics is well within the principles of economics. So you can apply those economics principles and understand it. And this, what we discussed, apart from linking it to bonds and prices and quantities in terms of its behavior, this is no different to your goods market equilibrium analysis. You must have done many times in your economic classes. Okay, any questions? Yes, there are some questions. I see you all have sent it out. You say here we are considering only the price, right? They're asking, are there any other factors related to this bond market? Yes, there are a number of other factors, right? You have risk, already you know. You have liquidity, you know. Expected return, you know. It's there. And creditworthiness of the issuer, many other aspects, it's there. But all will boil down to the price. If the higher risk is there, right, you probably find the price of that bond is not high, it would be lower. Higher the risk, people expect higher return. Higher return means higher interest rates. Higher interest rate means what? Lower prices. Higher the liquidity means more people demand. Right? So when more people demand, it's naturally the price tend to increase. That means interest rate decrease. So everything else in the market, financial market, can be converted and presented into the price. If there is a news tomorrow, the CEO, well recognized, highly reputed general manager of this financial agency is going to retire or resign, you see prices of those financial assets changes. Why? That reputation risk. Right? So that's why in financial markets, you don't let even such resignations or step downing to happen immediately. You have to announce in advance, 6 months ahead, 1 year ahead. There are systems established. You have to make a public announcement. End of next year, so and so would step down and who will take over. There are announcements in stock markets. And when the period of elections, government change, people sometimes take a wait and see attitude. They don't invest. They wanted to see who is going to take the power. If it is really certain, they don't worry about that. They know who would come to power. But if it is at a very tight contest, they probably wait until the policy is been and the outcome of the election be known. So less demand during that period. Though even the people who has purchased would not trade, they become conservative. So everything that you see can be brought into the price. But there are many other factors underneath this price that makes the price to move, behave. That's why we bring price into the equation. So in goods market, you had coconut, you had all these apples, right? You have dresses, handbags, lipsticks, whatever. What happens there? Rain, supply disruptions, transport difficulties. What happened to the price? That get reflected in the price. If the floods there in a central part of the country where the vegetable supply is disrupted, what happened to the vegetable prices in Colombo? So you can bring everything into the equation. So price would reflect everything happening. So that's why we have taken price. So behind the price, you know what is the behavior of interest rates, because you want the return. Investors want the return. They measure this return in terms of interest rates. So price and interest rate has a negative or inverse relationship. Price and quantity demanded has a negative relationship. Price and quantity supplied has a positive relationship. The coconut prices increases mean more coconut will come to the market. When prices of coconut decreases mean even available coconut we not put it to the market, they keep that and hide them until prices increase to be taken back to the market. So this is the behavior. This is the behavior of so-called rational human beings. So they are looking at their maximization of benefits. So we have seen theory of asset demand, the factors, how wealth, expected return, risk, and liquidity behaves. So you can put everything into the price and then equate and discuss this. Okay, any further questions? Right. So the market equilibrium, you have already seen this in the chart we have discussed. Right? So market equilibrium occurs when the amount that people are willing to buy, that is the demand side, equals the amount that people are willing to sell. That is the supply side. So where the demand side and the supply side meets each other, that's where the market equilibrium shape up. And you can have the price, you can have the quantity. It's no different your basic general understanding of how the goods market works. Then you see at equilibrium point, bond demand curve, right? And bond supply curve, that's the market clearing point. There is no excesses. At equilibrium, no excess supply, no excess demand. At points away from equilibrium only, you find excess points, such as when bond demand is greater than bond supply, that is below the equilibrium price, at lower prices, there's excess demand. So to move towards the equilibrium, then what has to happen? Prices has to rise. That means interest rates has to fall. That's what we have seen in the chart. That is here. In these points, this area, this is excess demand points, where the BD is greater than BS. So to bring that to the equilibrium, prices has to increase. That means interest rate has to decrease. At points where BS is greater than BD, that's the bond supply is greater than bond demand, that's where the excess supply exists. So to bring that to the equilibrium, prices have to decrease. That means interest rates have to increase. So here, prices decreasing, interest rate is increasing. So that's where you can take out the so-called inequilibrium from the market. Okay, so then you see changes in equilibrium interest rates. What happens when the demand curve shifts? When demand curve shifts, the equilibrium points also shifts. You probably see new equilibrium, you can figure it out. So as I mentioned at the theory of asset demand, so wealth will expand with growing wealth would expand the demand. In an expansion of wealth, what you mean here is the wealth is growing. The demand curve for bonds will shift to the right. So it's expand. You will find the demand curve, what you have now seen in the equation, would shift to the right side. At each price point, now the people who have more wealth will be able to demand more quantities. So it is shifting to the right. Then expected return. Right. Expected return. Higher expected return in the future. You see, people expect interest rates in the future to increase. So what that immediately does is, expected return of the asset and demand is positively related. You look at bonds, its expected returns are increasing, means you are positively demanding more bonds in comparison to other assets. But when you see, this is a very tricky point. Most people confuse this expected return and expected inflation to some extent in their understanding and interpreting the changes. When you see expected return, if the future returns are higher, as a rational investor, I would not go and invest in currently low return long-term bonds. What I will do is pull my assets to short-term bonds. So the short-term bonds demand would go up, but long-term bonds, because why I wanted to invest now, next year the interest rates are going up. Expectation is there. So the people would tend to reduce the demand if the expected interest rates in the future is greater for long-term bonds. So I would take a precautionary move there in terms of reducing my demand today, expecting to demand once the interest rate increase in the future. So it is from an investment jargon, what it says is why I should lock long, lock means invest long, when the interest rates are lower, where the interest rate is expected to increase in the future. Because future interest rate is higher. So I would definitely know I can invest in the future at a higher interest rate than investing today at a lower interest rate, means much higher price. So expected return behaves to reduce the demand, and demand curve would shift to the left in such circumstances for long-term bonds. It is very tricky, but understand it. Now you know why I don't want to demand now for long-term bonds when I expect interest rates to increase, expected interest rates to increase in the future. So then you see expected inflation. Okay. When the inflation is expected to increase, right? So naturally, the expected return for bonds decreases. And you can put this into the real return equation also and analyze this from real return perspective also. Nominal interest rate equals real interest rates plus expected inflation. Now, nominal interest rate is given. Assume it's 10. Expected inflation is 2. Sorry, real return is 2. And naturally, 10 minus 2 would give you the expected inflation. Now you see expected inflation is also increasing to 10. Then what happens there is nominal interest rate also has to increase to 12 to make the real interest rates 2. Otherwise, if the nominal interest rate is 10, where the expected inflation is increasing, that increasing expected inflation will eat into my real interest return. So the results here is expected inflation would cause the demand curve to shift to the left to reduce the demand. Okay, so this is you have to understand the working behind these elements to see where the demand curves move. Then the risk. It's reasonably straightforward. When the risk is increasing, more people will move away from demanding that bond. An increase in the riskiness of a bond causes the demand curve to shift to the left. Less demand, lower demand. Higher the risk, lower demand. So the demand curve would shrink, if not shift to the left. Liquidity, fair enough. Increasing liquidity. I can, without any problem, easily convert speed and ease in which I can convert the assets into cash form. Higher the liquidity, more demand for the financial assets. As a result, demand curve would shift to the right. It's expand. Okay, so this can be seen here as demand increases. You can see here previously yellow demand curve has now moved to BD2, bond demand curve 2, where for each price points, more quantity can be demanded. And if it is other way around, if the demand curve shifts to the left, where the factors drive demand to be lower, then you probably see a demand curve not in the direction of a BD2, but something in between 0.2 BD1. It is shift towards your left side. That's possible. Okay, so then we are seeing here each variable, how that drives the bond demand curve. The wealth, increasing wealth would contribute to increase the quantity demanded at each point in the bond price curve. So what you are basically seeing here is the shift towards rightward. The bond demand curve is increased. Higher demand is when the wealth is increased. Expected interest rate. You see, increasing expected interest rate, as we discussed, reduces the demand for long-term bonds. So the change in quantity demanded is reducing. The arrow is downward, not upward. So the demand curve is shift to the leftward. Okay. So then you see expected inflation, right? So increasing expectation for higher inflation in the future, higher expected inflation would reduce the demand for bonds at each price point. So as a result, you find the bond demand curve shift to the left because bond demand has reduced. The riskiness, higher the risk, increasing risks would drive the demanders to demand less bonds, and the demand curve would shift to the left in that instance too. And the liquidity, as you already know, it's positively related. Increase in liquidity means you will be able to much easily convert the financial assets into cash form at any given moment of time. Ease and speed in which you can convert this asset into cash form would also increase, and as a result, more quantity being demanded and the demand curve shift to the right. So just keep this in your framework in the picture, so you know where the directions in terms of the behavior of the demand curve. Okay, any questions before I move in to discuss the supply side of the supply side changes? You can see the supply side now. Right. So now we looked at the demand side. We'll move to look what happens to the supply side. So the shifts in supply of bonds. Expected profitability. Right? So when you see your business or your investment has more profit opportunities, invariably you see expected profitability of your investment is expanding. It's natural for you to expand your business. Rational behavior. So you expect more opportunities for investment. As your profitability expectation increases, you expand, meaning to say you supply more. More supply means supply curve shift to the right. You have seen upward slope in supply curve, that also expanding and shift to the right. Then expected inflation. You have seen when expected inflation happens, the behavior of demanders. But when it comes to suppliers, now you have estimated, let's say, 10 billion of bonds to supply because your cash flow requirement is that much based on existing inflation numbers. But if you expect now inflation to increase, the 10 billion that you have expected to cover your investment would not be sufficient. That money would not be enough for you to get your expected task completed. So you probably heard and seen people are talking about cost escalation and things like that. So when you see cost escalated, you have to bring in additional investment. So when you see expected inflation is increasing, the suppliers have to supply more to get their investment or the business done. So that also pushed the supply curve to the right. That means supply also increasing. The government budget, it's nothing new. Everybody knows countries like Sri Lanka continuously run deficit budgets. revenue is not sufficient to meet their expenditure. At times, even the current expenditure, forget the capital expenditure, right? So increasing deficits makes the government to raise funds by supplying more bonds. So the supply curve shift to the right, it expands. So you can see here, compared to demand curve, shifts in the demand curve that we discussed, the supply side is reasonably straightforward. Expected profitability, expected inflation, the deficits, budget deficits, all push the supply curve to expand. That means to shift to the right. So you can see that also here. The profitability, the variable is increasing. The quantity supplied at each price point also increasing. And as a result, you see supply curve has shifted to the right. You see expected inflation. The variable changes to increase the expected inflation. As a result, the quantity required now is also need to be expanded. So you can see the supply curve shift to the right in this instance too. Then you see the deficit, government deficit, budget deficit. So the change in variable is increasing deficits. You need to supply more bonds to raise funds. So it's naturally shift to the right side and higher bond supply is established. And you can see this in the supply curve here from our previous discussion of the chart. The supply side BS, now increase in supply, shift the supply curve to the rightward, and you find BS2 for each price point. Now you require to supply more bonds, and in any point the supply reduces, then you would end up having a curve inside the BS1 closer to zero side or to the vertical axis. Okay, then you see some changes response to change in expected inflation. You already know the individual behavior of demand and supply for expected inflation. So you can see the demand side now. A rise in expected inflation, as you already know, would reduce the demand for long-term bonds, that you already understand. So rise in expected inflation would result in shifting the bond demand curve to the left. Rise in expected inflation, shift the bond demand curve to the left. You have already known this when we were discussing the demand curve, shifts to the demand curve. And you can see here the original demand curve BD1 is now shifted to BD2. And if there is no change to the supply curve, you probably see the equilibrium would have been here, not in point 2. It would have been here, but you already know expected inflation also drives the supply side. There's a shift in supply curve too. The bond demanders reduces the demand, but suppliers now require more funds because cost has escalated because of expected inflation, which drives the supply curve to shift to the rightward. So what you are seeing here is the bond supply curve BS1 has moved to the BS2. Now you are not in BD1, bond demand curve 1, and bond supply curve BS1. But what you are simply seeing here is your equilibrium now established in terms of new bond demand curve, which is lower than the previous demand curve, and new bond supply curve, which is higher than, more supply than the previous bond supply curve BS2. So the new BS2 and BD2 interact each other at point 2, where a lower price than original equilibrium is established. And you see here the quantity has not changed, but that also could change by the distance of change of demand and supply curves, or the slope of these curves. That could happen. But generally what you are simply seeing here is because demand is now low demand in the market, but more supply in the supply side, you have to incentivize demanders to demand by offering them higher interest rate. Higher interest rate means lower prices. So price from P1 to P2, it's lower. And from a supplier side, you can't now expect higher prices because you want more bonds being raised. So you have to accept somewhat lower price. That means higher cost of borrowing. And that's why they are agreeing to a lower price in this instance. This is how the market adjusts its equilibrium points in the wake of a change in variables such as expected inflation. Okay, and then you see here interesting behavior of treasury bill interest rates in US. When I say interest rates here, it's nominal interest rates. That is the light yellow color curve that you are seeing here. And then you are seeing the expected inflation during this period of time, that is in red color. And in US, yes, you see inflation numbers are announced and expected inflation numbers also announced. And it's publicly available. In Sri Lanka too, you see the inflation numbers are announced, but you don't necessarily see expected inflation numbers being also publicly published. But yes, expected inflation surveys being carried out by the central bank often. They have household expected inflation survey, academics, professionals, different groups of people in the economy to see where their expectation in terms of future inflation. That is very important information for policymakers to define the direction of inflation. But what we are simply seeing here is generally, right, when the expected inflation is increasing, interest rate also follows suit. That also increasing. When expected inflation is decreasing, you can see here the interest rate also decreasing. Mean to say, you expect next year, let's say at this point, you expect next year expected inflation to decline. Okay? So you know now, the demanders would now see expected inflation is going to decline. So mean to say, future interest rate also to decline. So then you go and demand more bonds of long term. More demand for long term would itself increase the long term bond prices. What that would mean is the bond interest rate would come down. You can see here, decreasing expected inflation enable interest rate also to decrease. This is treasury bills. You can link the assets. I took the long-term one to explain there. And here too, you can see a very nice reflection of decreasing expected inflation and decreasing interest rate. Increasing expected inflation, increasing interest rates. Decreasing expected inflation, decreasing interest rates. And here expected inflation also in negative territory. This is 2010. This is during the period of global financial crisis. As I said, we will be discussing in great detail. And here what you are simply seeing here is nominal interest rates are almost at the zero flow. Right? So you should be able to look at a chart like this and explain. You don't need to just say, oh, it is interest rate and expected inflation. Everybody can see that. But you should be able to explain the fact that expected inflation makes what it's drive, how it drives the supply side, how it drives the demand side, and as a result, the bond prices and invariably interest rates. When you can see bond prices, supply and demand sides, you can quickly figure it out what you would be looking at in terms of interest rates, because you know price and interest rate relationship. Okay. Then you see business cycle expansion. Business cycle expansion, profitability. Okay. And mainly when you see business cycles are the growth periods. You see the economy's growth periods are continue to lengthen. Growth to continue for a longer duration. So you see more bonds being supplied. So the supply curve is expanded. BS2. The demanders, because of the economy's continuous expansion, they become wealthier. The wealth expands. When the wealth expands, and because of new expanding economic activities, you become more paid, you get more opportunities to work. People who are not in work also get employment. They also work. Then more demanders. also come in. As a result, the demand curve also shift to the right. So increasing economic activities, expand economic activities, push the supply curve much stronger. And also you see the demand curve also expand, but not to the extent or the strength of supply curve. As a result, more supply of bonds and more demand of bonds, but more supply is stronger, thus price being pushed down a bit. And new equilibrium you see at point 2 with higher quantity of bond supplied, and equilibrium point is higher equilibrium quantity of bonds in the market. So you can see this. So this type of relationship you should be able to establish. Okay. And we will start from this business cycle and interest rates behavior and start to move on to further explain this. I do longer in terms of explaining this because these are very important concepts. You have to understand and get it when it's available. You should be able to detail it out. Any further questions? Right. If there are no questions, we will stop at this point and we'll start at this point. But there's a question here: will the excess liquidity in the system and excess liquidity itself available in the system means more opportunities to buy bonds, because what you are simply seeing is excess money available in the system. Liquidity in the analysis that we set, more liquidity, higher liquidity, what we referred there is ease and speed in which you can convert that. Now when you see ease and speed in which you can convert when the more liquidity is available in the market, you can see that bonds demand increases. That demand increases means prices also increases. When the price also increases, right, what you're simply seeing is interest rates decreases. Liquidity itself, excess liquidity itself would drive the interest rates to decrease. Okay, and you can figure it out in a way. When the interest rates are decreasing, there is a possibility people search for alternative investment opportunities. Bond market versus equity market are the close competitors in terms of investment opportunities. When the bond market's returns are decreasing, people tend to move to the equity market and they prefer equities. So the stock market have a preference. It's not necessarily crash. Okay, so it is effectively lowering interest rates when you see excess demand and excess liquidity. Lowering interest rates would reduce the cost of financing. Lowering cost of financing means the small time investments also can move on without having much difficulties because their cost of borrowing is now low. And this also push more preference to the stocks in the market of alternative investment opportunities, because they probably look at bond returns versus equity returns. So they are going to kind of buy more equities in such circumstances of these different asset classes. So it's not going to create losses to small scale investors. What you probably see is lowering interest rates would reduce people who are relying on interest-based incomes like pensioners, right? So there's no other income, so they see their bulk in terms of volumes that they receive periodically. But now, because of low interest rates, that amount has come down. But government has made different policies to compensate up to 1.5 million of investments at a high administrative interest rate. They can get higher return. Okay. There are other disconnects in terms of business cycle and the market. Yeah, there's a possibility. There may be possibilities where the real economy is not yet pick up, but market would be stock market is rallying these days. Maybe because people have more savings, because the expenditure has come down because of COVID, lockdowns, no travel, no additional expenses, no parties, lot of things. These are all middle income and above. But small timers, small daily wage earners, yes, they have difficulties. These are common things in economies everywhere. Anyway, I mean, we can continue this type of interpretations with the knowledge that you all are gaining. So we'll stop at this point and we will continue the discussion, and probably we will have a new session also starting next week. Thank you.